There's something bigger happening than just interest rate hikes, inflation fears, or a few bond auctions going badly. What we're seeing right now is this. The world is beginning to lose structural trust in the US dollar. And once that trust is gone, it's hard to get it back. Today, we're diving into why the dollar's role as the center of the global financial system is starting to crack, and what that means for US policy, global markets, and investors around the world. Let's get into it. So, what triggered this? Even after former President Trump reversed course on tariffs, the damage was already done. Market participants have begun to re-evaluate the dollar's appeal as the world's reserve currency. Just last week, we saw the dollar fall alongside US Treasury bonds. That's not supposed to happen. These are traditionally seen as safe haven assets, but both sold off at the same time. And this is more than just a correction. This is about a deep, structural repricing of trust. This is what de-dollarization actually looks like. Let's start with the first big shift. The US is running out of fiscal room. Now, most people think a country's fiscal capacity is all about debt to GDP ratios. But here's the truth. What really matters is how much the country relies on foreign funding. And that's exactly where the US is vulnerable. For decades, America has run twin deficits, budget and trade, and gotten away with it. Why? Because the dollar was the global reserve. Foreign investors had to buy US Treasuries. But now, that dynamic is changing. Foreign demand is softening. Interest rates are rising. And the sustainability of US deficits is under review. The US is beginning to look less like the exception, and more like everyone else. Second, foreign policy is becoming a financial risk factor. The US financial system now depends heavily on foreign investment. That means foreign perception matters more than ever. And here's the uncomfortable truth. The US, like other twin deficit countries, is becoming dependent on the goodwill of international capital. So, every time a policy misstep happens, whether it's a tariff war, sanctions blunder, or an offhand comment like buying Greenland, markets pay attention. Confidence erodes. And now? Foreign diplomacy is becoming inseparable from financial market stability. If America wants to keep foreign capital flowing, it has to shift toward more cooperative and less confrontational diplomacy. Now, let's talk about what this really means for markets. Some analysts are already saying that the US market is behaving like an emerging market. Why? Because both bonds and the currency are selling off at the same time, a classic M pattern. But here's the difference. The US doesn't have large amounts of foreign-denominated debt. So this isn't about default risk. It's about valuation reset. In other words, foreign investors aren't fleeing because the US can't pay, they're stepping back because US assets no longer look worth the price. Overvaluation, high foreign ownership, and an aggressive foreign policy stance. Together, these three factors are triggering a slow but steady repricing. So what happens next? To become attractive again, US assets will need to correct a lot. This could mean lower bond prices, weaker dollar, or wider spreads, maybe all three. And that's painful, but necessary. Until that repricing is complete, the US market could remain volatile, and more dependent on external sentiment than at any time in recent history. Let's zoom out. Globally, this shift is a double-edged sword. On one hand, currencies like the euro might benefit as alternative reserve assets. That gives the eurozone more fiscal flexibility, a welcome break from years of austerity pressure. But there's a catch. If the euro rises too much, the ECB may be forced into more dovish policy just to avoid export destruction. So even winners in a de-dollarizing world face their own trade-offs. And now we arrive at the big question. Is the dollar's dominance over? Not yet. But this is how it starts. Not with a crash, but with a slow, grinding loss of trust. Asset managers begin to reweight. Central banks diversify reserves. Sovereign wealth funds look elsewhere. And as that shift plays out, we're seeing early signs of a new global monetary order forming. One that's less US-centric, more fragmented, and more unpredictable. So what does this mean for you? 3 things. Watch for signs of US fiscal restraint. Without it, foreign capital may demand higher risk premiums, or disappear entirely. Track US diplomatic tone, because diplomacy is now a market variable. Expect valuation reset. Especially in treasuries, and especially if volatility rises. And above all, understand that capital flows are being restructured globally. De-dollarization is not a meme anymore. It's a market reality. Let me know what you think. Are we witnessing the end of US financial exceptionalism? Can the dollar maintain its dominance without trust? Comment below, like if this made you think, and subscribe for more deep dives into global finance and macro strategy. This isn't about the next rate hike. It's about the next era of money. And it's already started.